well, definitely type them in there. So let me get the questions out. Show questions. There we go. And attendees. There we go. Polls, chat. Okay, we're in business. Okay, guys. So the big mover obviously is crude oil, and we have seen a lot of volatility around crude. So we have crude down currently 2% pre-market, right? So we're down at 62.52. And I mean, this is extremely interesting here in the markets about what's happened to crude. There is all sorts of fundamental implications as to what is happening with crude, and I'm going to take you through just a couple of them. But the most important thing for traders like you and I is this move in crude is injecting volatility into the market that is just awesome. It's just great. We have positions in the XLE going on our stock option service, the energy ETF. We've been trading the dollar against major oil exporting nations, which are getting crushed right now because of this drop in crude. To kind of set up the story, look at this. I'm going to jump into some FX markets. We love FX, especially in volatile times like this when commodities are moving and there's big interest rate differential movements and central banks are going to raise rates and some are cutting rates like we have now. And it's just creating massive volatility in currency markets. To start off with, and I doubt you guys thought I would do this, look at dollar against the Russian currency. Yeah. In 2014, dollar against Russia went from 32 to 54. That's a 50% move. In currencies, guys, that just doesn't happen. Currencies move a fraction on a percent basis that the stock market does or commodities do on a given day. Okay, currencies move a 0.5%, 0.75%, maybe on a massive day. This thing has almost doubled in 2014. That is just huge. That's like the stock market tripling or quadrupling, or the stock market falling by, by 400%. Obviously it can't happen, but this is a major move. And Russia is a major oil exporter who is in big trouble with this crude oil collapse. Okay, dollar Russia is on the highs. Venezuela is another country that is a major oil exporter who's in big trouble. Well, we can't trade the Venezuelan currency, but if we could, that thing would be up through the highs. Here's another one that's a little closer to home. Dollar against Mexico. They're a major oil exporter. I mean, this thing has just gone parabolic. And what's happening here is the dollar is strengthening against the second currency. So those of you who aren't familiar with FX, let me just go up here and show you that as this USD MXN, dollar MEX, as this chart goes higher, the first one is always strengthening and the second one is always weakening. So the dollar strengthening, Mexico is weakening significantly, right? So as you go over to dollar ruble, I mean, this thing is right through the highs, right? So we have just a major, major move going on here in the dollar, and it's all rooted in oil. A currency that we've been trading very heavily is dollar Norway. Norway is I think it's the sixth biggest natural gas exporter in the world. They're a major exporter of Brent, and dollar against the Norwegian currency is really moving. So guys, you might be thinking, what are you talking about with all these crazy currencies? Guys, this is the ramifications for what's happening in crude oil. These kind of crazy thinner currency markets, these guys are moving, and this is where money's made. Okay, that is the kind of move you like to trade. All right. Short, sideways, choppy stuff, much like, for instance, bonds. I don't know if any of you guys are trading the bond markets, but just compare that against the 30-year bond. And it is just going sideways as soon as my data comes in, right? So we had a major move up in bonds, but just going sideways, sideways, sideways. So it's important, guys, to understand, where the flows are, where the volatility is and where the trends are, because that's where money's made. Okay, I've tried to trade this. I've tried myself and with customers to try to trade this twice. Stopped out twice. It's just chop, 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 chop. Okay, so I know now, like, this is not the time to be trading bonds. Bonds are very important in terms of the intermarket scope, but that is not the movement right now. The movement is over here in crude oil with a nice trending market. The move has been decent in gold. Gold is all of a sudden starting to act strong, which I want to talk about. We've had a really nice move down in gold in the summer into the fall of 2014. And then all of a sudden in November, we've begun to squeeze higher. And there's a major point in gold that I want to talk about. So, it's really important to understand what's going on in the intermarket perspective. Hey, Tony, how you doing?
Good, good. Sorry, out of late.
Don't let it happen again. It's a good thing
Okay.
you're the boss of MotiveWave. So how's it going?
Good, good, very good.
Nice. Um, So anything new? I know you have a new update coming out. I don't know if you can talk about it yet, but that puts you on the spot. Anything new that we need to know about, or business as usual?
Well, working pretty hard on version 4. So if you're out there and you're wondering, why you haven't seen an update since October the 7th, well, it's because we're really hard at work on version 4. So hopefully we'll have that out in early 2015. I'm hoping sometime in January if everything goes well.
Okay, cool. Yeah, and I know I'm lucky enough to talk to Tony quite a bit, and I know there's a couple of features in there that a lot of us will benefit from. So I won't say anything more, but looking pretty good, right?
Yeah, no, it's all coming along really really well. But there's some pretty significant features going in there. So.
Awesome. Yeah, I'm pretty psyched. Yeah, you haven't had one out. I mean, usually Tony, the good thing about MotiveWave is he'll come out with in the past, I mean, this has been a 3, 4 year ramp up, and he'll have an update every, on average, week, two, and if you have the full version, you get all updates. Um, and he hasn't had one out for like a month, so there must be something big going on behind the scenes. So that's pretty awesome. All right, so unfortunately, we're talking about crude oil, and I got to tell you, Canada is getting a little beat up as well um, with this crude oil collapse. You noticing anything going on up there? Any implications on or any impact on this crude oil movement?
I haven't noticed myself, but I'm quite happy with the dollar where it's going.
Yeah, there you go, there you go. All right, perfect. So just hop in if you want to jump in any of the conversation, but we'll be here.
Okay.
All right, sounds good. So that just again, that was Tony. That was the he's the founder of MotiveWave, and we work pretty closely with him. So pretty awesome. So the from the intermarket point of view, as we were saying, here is the big move that we've seen. Crude oil has dropped very sharply, and gold has been going with crude fairly well. And if we pull the dollar aside and crude, you could see that there is a pretty good inverse relationship here. So as crude is declining, the dollar is strengthening, and that's one of the key relationships. That's one of the most important intermarket relationships. One, these are the best volatility. This is the best volatility of the markets, and the best volatility means the most emotion. Emotion includes fear and greed. Fear for people who are short crude, and greed for people who are short crude. Obviously greed for people who are long the dollar, and fear for people who are short the dollar, right? So, when you get those high degrees of emotion, that's when technical patterns, guys, work the best. I always laugh when people say, well, technicals don't work when markets are volatile. That is the most ridiculous thing I've ever heard, because the reason technicals work is because emotions are running high and people make irrational emotional crowd following decisions. And when you do that on a mass scale, that creates very common, repeatable, well-defined technical patterns in Elliott as well as any other more simple technical analysis methodology out there. So emotional markets are the most technical. When you get a market that's just kind of boring and low volatility and just going sideways without any real fear or greed or anything kind of going through the market, that's when markets tend to wander and don't really respect stops and support resistance and stuff like that. So You got to trade the emotional volatile markets because that's where the volume is and that's where the emotion is and that's what makes technicals work. So we've really been focusing on long dollar and short crude, and that is the play. Like I said, we are short the XLE right now. Let me just go to our stock desk. I'll show you our positions right now. We do have some option positions in the XLE, which is your energy ETF. We sold an 82.83 vertical for 21 cents in Jan, and then we bought an 80.75 put vertical for $2.60. So we're short premium up here, and we're long the vertical down there, right? We've been trading dollar against that Norwegian currency topside, so I can show you some setups there. But what's interesting is gold, has been. Let me get crude out of the way. Gold has been performing pretty well with the dollar. So gold here in orange has been trading inverse the dollar, but all of a sudden, look what's happened here. Gold's gotten crazy here in November. Gold and dollar trade in the same direction, right? That's not good. That's like cats and dogs living together. It just doesn't make sense, right? So this is a break from the normal correlation that we'd expect. Okay, so gold has come back, and what's happened is gold tends to act as a safe haven play when markets get volatile. And if any of you watched the VIX yesterday, that volatility index, it was up pretty good yesterday, and on a major reversal in the stock market. So gold is starting to act like a volatility hedge. So that's why you're seeing a departure from the normal higher dollar, lower commodity play. Okay, so right now the clean correlation is higher dollar, lower crude. And if the dollar were to start moving lower as a little short-term pullback, you would expect to see some pressure come off crude. Okay, and actually what's happening is if crude were to rally first, the dollar would then sell off. Crude is leading the show right now. Okay, crude is in charge, and if crude were to bounce, you would start to see the dollar sell off a little bit. Okay, and then we could pull in the bond market. As I said, I'm not a big fan of bonds right here. They're acting kind of crazy. So they're acting pretty well here with the stock market. So the S&P is here in black, bonds are here in blue, and as the S&P is kind of topped out a little bit here, double top there. We've had a double bottom there in the bond market. So we got a pretty good inverse relationship there. And I think maybe that part of the reason that bonds have not been trading well is because the S&P through all of November has just been bumping up against this 2073 level forever, not really getting anywhere. We finally broke down in the S&P, and you're starting to see some volatility there, and that was kind of moving the bond market higher. Okay, so the good relationships right now are stocks and bonds trading inversely, crude and the dollar trading inversely, and gold right now is kind of doing its own thing. Okay, so Jay, to answer your question, I didn't put Tony on the spot in terms of what features specifically, but you'll definitely know when they come out. Brett, yeah, algos are nailing the fibs to the penny, especially in intraday. Yeah, I mean, I think it's algos that are making markets work around fib levels, but I also think to a larger extent, it's emotion in the market that people tend to react at markets on a collective basis tend to react at those fib levels. So I think it's algos, but I also think it's just pure human emotion, which make no mistake, pure human emotion is cooked into those algos. And guys, big algo firms don't just run one algo all the time. They have multiple algorithms that they deploy at different times, and there's emotion involved in deploying a certain algorithm. So don't just say it's all the systems. Trust me, there's good old fear and greed in this system. All right, so let's go to crude, and let's kind of look at where we are. We are breaking down right now. That is awesome. As I said, we are short crude right now via that XLE option play. So that's awesome. Let's take a look at where we are longer term. We are testing the 2009 low, and as of like last night and today, we've broken it. So that's pretty awesome. We've broken through the Feb 2009 low, which was post-credit crisis. Look at this, just crushed in crude. So it's been a pretty good move, from 100 down to 62. But where crude has come from and what it's capable of, Credit crisis saw crude go from 190 to 65. How you doing? It's a $130 move. You know, as a percent of 190, oh God, let me do this. 160 percent, 109. I mean, I'm going to guess like 80%, 75%. I don't know. Somebody's better at math, tell me. But that's a big move. Okay, so when you're looking at longer term charts like this, you need to go to percent change. And what I've done is changed my charts to semi-log right there. Okay, so it's on semi-log. So basically, look, the move from $40 to $50, that's a $10 move. Is a percent of 40 is a 25% move, right? So basically, just take, where's my pen? Take this. This is very important. Take that distance, 40 to 50, that arrow, and I'm just going to replicate. I'm not looking at the price scale. I'm just going to draw another arrow that looks to be about the same size, right? So we had a move from 40, oops, from 40 to 50. That's a $10 move, which is 25%, right? Up here, if we do another 25% move, how about 180 to 230? I'm just eyeballing it, right? So that, let's call that a $50 move, where this is a $10 move. 25% down here is a $10 move, or 25% up here is a $50 move. And what happens is when you start looking at these longer term levels and these longer term charts, because we have markets that are really testing much longer term levels, you need to move over to that semi-log. And what's going to happen is that's going to change where your fib and trend lines go. Fib projections and extensions and retracements will change when you go over to that semi-log scale. So let me demonstrate here. Okay, actually that's not even our preferred count. This is the count we're working in crude. Okay, here's our wave count in crude, and let me just kind of hide this degree, keep things simple. There we go. Get rid of him. Get rid of him. Okay, perfect. So what we're looking at here is an A wave decline, a B wave triangle, and then a C wave decline. All right, a lot of times the relationship between A wave and C wave will help you predict how far this crude oil decline is going to go. So let me get rid of, oops, Control Z, edit undo is a godsend. Okay, so what we've done is taken the distance from 192 to 64 and then projected it down by your fib retracements or fib ratios from this high. So we're looking for an A wave compared to the C wave. All right, let me just get rid of the one we're not using, B and C. Okay, perfect. Ratio analysis. Oh, it should have only taken the C and B, not both of them away. C and A. Okay, so what this means basically is this move from a percent basis 192 down to 64, that percent change will be the same from a move up here down to $34 a barrel. That would be pretty significant. What I don't think is significant and what I think is absolutely attainable is the 0.618 relationship of A wave compared to C wave. You hear everyone talking about $50 oil and what the implications are going to be, and how many businesses and this high yield debt is not going to be able to be financed. A lot of these energy companies, weaker hands are going to go out of business, and it's going to shake a lot of people out around the $50 level. So it's no coincidence that the 618 projection of A and C is down at $52.50 based on a log scale. All right. So just put real simply, let's say this was a $100 move. Okay. Well, it's actually not correct because we're on a semi-log scale. But let's say this was a 100% move. Okay, let's say this is 100%. That's your 100% right there, as it clearly states. Now, just to drive that point home, a semi-log, keep this in mind. Your 100% was at $34.65, and your 618 is at $52. If we were to take the semi-log off, watch what happens. They change. Now the 618 is at $24, and the 100% is at minus $24. It can't work. So are you going to tell me crude, we're going to have to, Saudis are going to have to pay us $24 a barrel to take their crude? No, I don't think so. right? So that's when you're looking at long-term charts like this, you need to go to semi-log. I mean, literally that says minus $24. So that means we get paid to have a barrel of crude. Don't think so. So you got to go over here, semi-log, and then that gives you the real picture. So 618 is 52.5. So we are aggressively trading crude down to the 52.5 level. Okay. So let's see. All right. So let's break this this decline down. So we're on the weekly. Let me move over to the daily. Just kind of shift my chart over here a little bit. And we have a lot of wave counts right there. So let's hide. And this is great. I mean, this gets real confusing. And basically, what we do, guys, is I move time frames. So I have all of my wave counts set up like this, right? So I'm just scrunching. I have 6 monitors I look at. I'm using the top 3. And what I do is, and I look at the weekly here. I look at the daily here. This is usually the 3-hour, and this is the 1-hour, right? So you're looking at the same wave count, but across multiple time frames. And you don't need 6 monitors or 3 monitors to trade. I mean, I could easily travel and go on a laptop and just trade this way and just pop up the chart that I'm looking at. So it's pretty awesome. And what's cool is as you move across instruments, the wave count is saved and then loaded in each instrument. So I just pulled up gold. There's a gold 1-hour, gold 3-hour, gold daily, gold weekly. Okay, so that's kind of what I'm doing just to show you. All right, so we go out to the crude, back to the intraday. So we have a lot of wave counts here, that probably are better seen over on an hourly chart. So what you can do is hide certain degrees that you don't need to see. All right, so there we go. Now, remember, we're looking at this black sea wave that should get down to about the $52 level right there. So we have wave 1 and 2, and we're in the middle of a wave 3 decline. Okay, a wave 3, just like a wave 1 and a wave 5, will have 5 smaller waves. So the Elliott wave count is going to look like this. 5 wave move. 1, 2, 3, 4, 5. Your trend waves are 1, 3, and 5. Your corrective waves are 2 and 4. Your wave 2 and 4 should be choppy and sloppy. Often wave 2 is just a 3-wave move. Often wave 4 goes a little complex and tries to torture people. If you've ever seen a triangle or something, usually it's in the 4th wave. But what's important to remember is on the smaller time frames, each of your trend waves, 1, 3, and 5, will have 5 smaller waves. Okay, so wave 1 will go like 1, 2, 3, 4, 5. Wave 3 should have 5 smaller waves. 1, 2, 3, 4, 5. And wave 5 should have 5 smaller waves because those are your trend waves. Those are the waves that are projecting or pushing this pattern forward. So as we go from the weekly on this wave 3 over to the daily, we need to begin looking for 5 wave moves. Okay, so here's blue 2 on the daily on September 2014, same blue 2 over here on the weekly. So we need to be looking for solid, the biggest corrections in here to make up a wave 3 move. Okay, and if you're saying to yourself, well, I see a correction here and a correction here, yeah, you're right. But one of the rules is this 3rd wave right here should be longer than both 1 and 5. And basically the rule is it can't be shorter than both 1 and 5, but generally it's longer than both. Okay, so if you were to say, well, okay, here we go, 1, 2, 3, 4, 5, no good, because wave 3 is very short. So what that means is this thing is extending. All right, this thing is getting larger and larger and larger. So what I do is just keep drilling down to your wave 3. And basically what's happening is, let me just bring in one smaller degree. I'll go show you the intermediate degree. And there we go. Okay. And I want to keep that $64 level. Still, come on, stay there. Stay. Hold on. Stay. I can't stretch that. Okay. The $64 level is important because that was that Feb 2009 low right there. No, actually, 64 was the Feb 2009 low right there. So what's happening is this red wave 3 is breaking through it. It just slid off the left side of the screen, but you can see it over here on the weekly. The 64.38 is that key level, and it looks like right now we're breaking down in a wave 3 of 3. This is your biggest, baddest breakdown wave. And so far, this is what we've seen. Okay, so even inside of wave 3, all wave 3s must have 5 smaller waves. Okay, we're looking at red 3 there. We're looking at 1, 2, 3, 4, 5. And you're saying, okay, Todd, what about all this stuff in here? Well, keep going to smaller time frames. So we want to look at the move from November 10th down to today. And from November 10th to today is going to be, come here, let me stretch him out a little bit. There it is. November 10th to today needs to be 5 smaller waves. All right, and this is what we have. We have red 1, red 2, red 3, red 4, and we're looking to move lower in red 5. Right? So, you know, we had wave 4. I wasn't sure if this was wave 4, but we had wave 4 stop a pretty good resistance in the 70 level, and now remember, 1, 3, and 5 need to have 5 smaller waves. Can you count 5 waves inside of this guy? I think you can. 1, 2, 3, 4, 5. So I think there's a little bit more weakness to go. Oops. We got to do 1. We got to do 2. Sometimes you got to give MotiveWave a little help. 3, 4, and 5. I think we have one more push down. Okay, so how do you find the low? All right, how are we going to handle this XLE position based on Elliott wave? All right, there's going to be some wave 5 calculations that we're going to use to figure out how far this wave is going to go. All right, and this is really, really important. Okay, we have broken support at 64.38. This is major, highly visible technical support from February 2009. But I'm telling you that I and our customers, we are not going to chase through this break because we think there is a wave 5 low coming fairly soon. All right, because we have 1, 2, 3, 4, 5. And finally, the way you calculate a wave 5 low is you use these 3 fib retracement, or these 3 fib levels here. 5 versus 1 and 3, 5 plus 3 and 1, and 5v1. You don't even understand what they need to, what they are. All you got to do is just click 1, pin. Right click again, go down to ratio analysis, click the next one, pin. Click the next one, I'm looking for 5v1, pin. Now what you're doing, guys, is you're going to get rid of everything that's not green. I bring out my eraser tool. I'm getting rid of everything that's not green. All right, so now we have a green, and a green. So what we're saying here is there should be support down into the $60 level. We have a support zone from 64 down to 60. So we are short crude, yes. We are below the 2009 low, yes. But I'll tell you what, I'm not going to sit too long in this trade because I do see a wave 3 coming, wave 3 low coming, because we have 5 smaller waves inside of here. And we should be getting a wave 4 bounce. Okay, a wave 4 bounce should move higher towards the area of the prior fourth. Okay, up around the $70 level. Plus, we should do a fib retracement. Okay, you'll notice the 38% retracement is right in the prior fourth. So we are not going to be looking to sell this breakdown. In fact, I'll be looking to cover shorts. I think they're going to short squeeze them in oil back up to like 68. And at that point, when people say, oh yeah, the bottom's in, buy crude. Nope, that's when we're going to turn around and sell it into wave 4. Because we'll then have a wave 5 decline that, as you guys know, will unfold in 5 waves. So wave 5 will go like this. Here, let me just get these fib out of the way. And wave 5 will go down in 5 smaller waves. 1, 2, 3, 4, 5. So we have a trade plan. And that's the best thing about Elliott, guys, is, you know, is it guaranteed to be right? Absolutely not. There's nothing guaranteed in the markets except that they'll probably be open tomorrow, right? But the most important thing is we have a trade plan. And, I have a plan to say, I think we're going to sell down in the 60 level. I'm not going to chase this and emotionally short through the lows and get caught. Short, oh, cover, 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 cover. All right, finally I'm out of my position. Oh, that's a wave 4. Okay, and then the sellers come back in and push us down to the $50 level, which is where you thought we were going originally. Okay, so that's crude. We have a trade plan. Am I going to be right? I don't know. I think I probably be right, but if I'm wrong, I'm not going to lose any sleep over it, and I'm not going to make a costly emotional reactional trade. Okay. All right, so that's crude. Let's do natty gas here, which is also very related. And if you guys have any questions on that, comments, if you think, let me know what you think there. Was that totally confusing, or did that make sense? So it just kind of helps me customize the approach for you. Natural gas is, I think, moving into a third wave low here. And the way you calculate third waves, which is this actually this black wave 3 here, is you click on the degree you're studying. And let me just hide this degree and keep things simple. Okay. You're going to go ratio analysis, 3v1. And typically, the third wave gets down to that green 161.8% at 367. That's your typical third wave low. We've reached it, and we've started to bounce at it. Okay, so is this going to be the low? Well, that's your first checkpoint to say possibly. Your next checkpoint is, as I've said it a couple times already, your wave 3, as well as 1 and 5 need to be 5 smaller waves. So you right click and you let MotiveWave do the analysis for you. It can do automatic Elliott wave for you. Impulse. Oh, no, that's fine. I'll say yes. And I've hidden that smaller degree, so let me just go down and menu. Here we go. Oh, Tony, we got to change that. Got to change that. Decompose impulse. All right, and sometimes you got to give it a little help, and you're just looking for the biggest corrections. Okay, I mean, it actually looks like a larger correction there. 1, 2, 3, 4, yeah. So, and look, natural gas is starting to bounce. So we could have one more little push down, but I don't think it's going to get much below the 200%. So natural gas should also be setting up a bounce, very similar to crude oil, right, into wave 4. Right? So crude oil and natty gas are definitely trading together, and what you can do is watch this, add study instrument overlay, and we can just overlay the two. And I like to do these intermarket charts of correlated markets with the Elliott wave count on there. So I'm just going to overlay crude on top of it and just see how the correlation is. Here's crude over natty gas, pretty close. I mean, they definitely were diverging there in November, or early November, but since November 10th, they're right on top of each other. So this is how you substantiate your Elliott wave count. This is how you reduce some of the subjectivity. Do I know if wave 3 low is going to come in here in natty gas by itself? No. Do I know over in crude oil, is that wave 3 low going to come in by itself? No. But when you start layering Elliott wave counts of correlated markets together, you start to reduce subjectivity, you increase your conviction in that trade. Last 3 was shorter than 1. In which one, Jay? Graham says, like technical analysis poetry. Thanks, brother. That's funny. So, natty gas, am I going to be short? No. If anything, it looks like we have a squeeze coming. Let me just look at the higher time frame, and you always want to look for technical support. Do I see any support here? Not bad. Actually, looks like a 1272. I love doing the 1272 external retracement. So you just do this to this, and you look for 1272. All right, it's a little bit lower, 3.5. So this is that daily. Not showing the small degree waves, but 350, 345 natty gas low in that area. Okay. So that's that. Crude. Let's talk about gold, and then I want to do the dollar real quick. I know we spent a lot of time in there, but that was important. Jay, let me know which one you're talking about on wave 3 was shorter than 1, because Elliot, MotiveWave would have yelled at me if I did that, by giving me an error message. Okay, let's take a look at gold. Gold is at a hugely critical level, and let me show you why. Gold, as I said with customers last night in the nightly video, the next $50 in gold is going to determine the next 6 to 18 months in gold. It's so important right here in gold. So here's the weekly, and we've gone, of course, the log scale. And as I stretch this guy out a little bit, look, we have 2002. We have perfect trendline support coming in. We didn't quite test it. 1107, 1110, 1120 area was the trendline support, but we also had the high from 2008 at 1108. We had massive support there in gold, and unless you're using semi-log charts, you never saw it. You never saw it, because if I just took this and made it non-semi-log, watch what happens. It's not there. It is not there. So if you try to do trendline support off of a regular chart, ooh, you don't have support down to about $1,000, right? Okay, so it's really, really important. Even if you want to go off the lows here, right? This low to this low, you still don't have trendline support until like $1,050, right? So you are much better served doing technical analysis on long scales, because you will see levels that nobody else does. And there's your trendline support. So what's going on here with gold? Okay, from the highs here in September 2011, I'm very quickly being able to count 1, 2, 3, 4. We're looking for wave 5. Now, here's the question on the table. I've said a couple times that each of your trend waves, 1, 3, and 5, need to have 5 smaller waves. Okay, there's a possibility that this red 5 is in place, and we are going to do a short squeeze up to about 1,400 or 1,500 in gold. Okay, the reason I say that is, let me go from inside of this red 4 from 2014. Let's go inside of there. And here it is. We just get everything on the same screen. Okay, so there's the red 4 in July 2014 that matches up with this red 4. This is the daily on the left. This is the weekly. We have 1, 2, 3, 4, 5. Now, that qualifies as 5 waves down. That qualifies as 5 waves down, which means this could be the bottom of red 5, which means the decline from the high in gold is 5 waves and is done into that uptrend support, as well as that 2009 high at 1100. Okay, so it's very possible. Now, there's two possibilities. This is either all of wave 5, or as I have it laid out now, this is just wave 1 of wave 5. All right, so let me hide this in below. Okay, so it's either wave 1, wave 2, 3, 4, and then red 5 comes in down sub 1,000 down here. Okay, I don't know. And this is a little bit more advanced technical analysis, a little bit more advanced Elliott. But your takeaway, most simply, let me do the heavy lifting for Elliott Wave. The thing that I opened with is, we have two plans going to war here with gold. Okay, if this is wave 2 should find resistance into 1265, which is your green level, which is what you're looking for. 1265, maybe even 1300. This is a major resistance zone. If this is wave 2 of red 5, we need to hold resistance in here. And if we start to fail, then we're going to go down in 3, 4, and 5. Okay. Of course, you're going to look at your intermarket analysis. You want the dollar to rally. You want crude to sell off. You want silver to sell off. You want volatility to decrease. If gold is going to drop, you want volatility to decrease because gold is directly correlated to the VIX right here, volatility index. So from an intermarket point of view, you're going to help your Elliott wave analysis along by doing that. So if we fail in this 1265 1300 with a rallying dollar, falling crude, rallying VIX, or sorry, VIX that's selling off, then this wave count's probably going to take shape and we're going to go down. If, on the other hand, volatility increases, the dollar sells off, crude bounces, then this count could be wrong, and I will need to take red 5, put it right here at the lows, and if that's the case, okay, it's going to look like this. It's going to look like this. Let me bring in a few more counts. Okay, perfect. No, too much. Hide. It's going to look like this. If the wave 5 low is in, then a B wave rally is going to unfold, which typically goes to a 50% retracement of the 5 wave decline, which is at 1485. So, when I say the next $50 in terms of the next 6 to 18 months, here's what I mean. If we break through that 1275, 1300 area, we are headed up towards 1500 into 2016. Okay, because I've done a fib time comparison as well as a fib price comparison. We're heading to 1500 in summer of 2016. Okay, it could be, Jan 2016, could be summer, and then out to fall. But point is, not this coming year. Okay, so there could be a significant rally coming. I don't think so. I don't think that's going to be the case. It's our alternate plan. Okay, if gold fails into this 1300, then we see a 5-wave move down into the summer of 2015 around the $1,000 to $900 level. So this next $50 determines the next 6 to 18 months and several $100s in price action. So guys, that's how you use Elliott wave. I don't know what the wave count is. I don't know if this is wave 2 and we're going to sell off, or if it's the low is in and we are rallying now in a green 3 that's going to take us significantly higher. I don't know what the wave count is, but it does not mean you can't trade it. We have a damn good game plan to trade this. Okay, I am very interested in taking shorts against this level with a tight stop just above 1300. I'm going to risk $50 in gold to try to make 250. And if I'm wrong, fine, no problem. The risk was worth the reward. But if we get up to 1300, you can be pretty sure I'm going to be taking longs up here with stops back below this low, trying to make several $100s on the upside. I don't know what the wave count is, but you don't need to, because we have a trade plan, and the trade plan is derived from our primary and alternate wave count, and that's how you use Elliott as a trader. If you use it as a forecasting tool to say, oh, gold is going down here, it has to be a 5th wave, you're going to get killed. It's a trading methodology, not a forecasting methodology, and that's the difference. That's how we use it. Okay, guys, market's open. I didn't get to the dollar, but I think that was pretty complete, so we'll leave it there. Guys, we are, let's see, we are doing a seminar tonight, 10th and 11th, 2-day intermarket seminar on options on ETFs. If you guys are interested, just go to tradinganalysis.com and we'll sign up. It's a 2-day class. It's going to be about 4 to 5 hours archived, and you get the DVD. So we have some spots left there. And then if you want to take a trial to MotiveWave, you can go right there, MotiveWave.com, take the free trial, and it is obviously awesome software. We have a pretty cool quote there on the homepage. So, guys, hope that helps. Hope you enjoyed it, and we will see you next Wednesday. We do it every Wednesday. All right? Guys, take care, and best of luck.